We're live.
All right, thank you. Good afternoon. I'm Delegate Michael Jackson. I am the House Chair for the Joint Pensions Committee. I'm joined by Senator Sarah Elford of the Senate. Today, along with the members of the two committees, we're joined by our Treasurer, Nancy Kopp, and the State Retirement Administration. Today, we have our Joint Committee on Pensions 2020 decision-making meeting. For members, just a reminder, if you have questions, if you could click on the hand raise button and we will do our best to recognize you as we move forward. Philip, you can take it away. Sorry, Senator.
Nothing to add. Thank you, Mr. Chair. Just want to thank the members for making time in a busy holiday season for this important discussion.
All right, thank you. Philip.
Thank you. So the first thing we will be going through today is the decision items. There was one piece of board requested legislation and then another item that was presented at the last meeting for your consideration. That document should have been sent out beforehand if you all have it available. So getting into it, the first piece for the board requested legislation, provisions of the current code require the state to purchase a bond for each system fiduciary. In looking over this, the legislative history seemed to indicate that this was a requirement akin to something similar you see in federal ERISA law. However, ERISA doesn't apply to the state government plans. And so as part of this, the bond is meant to protect the plans against losses by, fraud or dishonesty, things like theft. To address this bond requirement, the Treasurer's Office has purchased a $1 million theft policy for the system. And the agency and Treasurer's Office did a review of bonding provisions and did not appear that the marketplace was providing that particular type of coverage instrument. And they also did not find much in terms of other systems. And so one of the board requested legislation is to amend the code to allow the state to satisfy this bonding requirements through the purchase of an insurance policy for the system. This would be consistent with existing practice.
Thank you. Anne? So I guess procedurally, Philip?
So yes, as far as considerations, the committee can choose to sponsor the requested legislation or choose not to sponsor.
Okay, I'd certainly like to hear from members, but I am certainly interested in the committee sponsoring this piece of legislation.
Sure.
Senator?
I agree if that's the will of the Joint Committee. If there's a motion.
So moved.
Second.
Thank you very much. If there's anyone that's against this motion, if you would indicate by either voicing or for those who can't connect, speak up if you're against this, or those who are on the screen by a thumbs down. Hearing. All right, Philip.
Delegate Jackson, I believe Delegate Krim has her hand raised. Did you?
Delegate Krim. Oh, yes. Okay, got you. Delegate Krim.
Yes, Mr. Chairman, I had a question. I'm opposing the legislation I supported. I had a question about cybersecurity. Do we have an insurance policy for that? Can somebody answer that question?
I don't know if the agency wants to respond. I think there was reference in the write-up about electronic theft. And do you know?
I believe that this insurance policy covers cyber, but I have not read the policy. Dean, do you know specifically?
There's actually going to be a separate policy engaged in by the Treasurer's Office. They're in the midst of procuring that today. But I'll let, if the treasurer wants to speak to it, but this policy is fiduciary liability insurance, does not extend to cybersecurity, but there is an effort statewide for this that the treasurer is leading that we will be a part of when that is put in place.
Okay, all right, thank you very much.
I'm happy to keep in touch with Philip or with the committee as we go forward. We are in the midst of procuring statewide insurance.
Thank you, Madam Treasurer. All right.
I saw Delegate Metzger make a physical motion. Delegate Metzger, did you have a? You're on mute. I'm sorry. Still on mute.
I was doing two things at once.
Okay.
Yeah.
I was going to second for the House side.
Thank you.
Thank you. Thank you very much. All right. That decision is made.
Okay, so that would be committee in favor of sponsoring legislation.
Yes.
Okay, the next item was something presented to you all. This relates to line of duty death benefits as it pertains to COVID. Existing law for the systems does provide benefits for line of duty death benefit of members of the several systems. If the UN employee is killed or dies in the performance of their duty, their surviving family members can receive a benefit of an allowance and return of member contributions. A question has arisen as to how these death benefits would be administered regarding members who die as a result of COVID infection. And in looking at the statute, on its face, there's nothing in the statute that would prohibit a member from applying for and being awarded such a benefit. However, it may be something that the committee and the General Assembly wants to consider, whether any clarifications or presumptions would be needed or helpful in affecting the plan design to provide these benefits. Clarification of how these claims should be administered by the system would provide equitable administration of the claims by establishing a uniform policy on what and when the member would be considered eligible for the line of duty death benefit and the types of information that would be needed to be submitted in support of such a claim. To date, DLS and State Retirement Agency are aware of only one state that's passed legislation. That was done in New York. There's also, I found legislation pending in New Jersey, which would affect a similar purpose. But quickly, the New York legislation, the features of that would provide accidental death benefits if the member reported to their usual work location or an alternative work location, but not working from home. If they contract COVID for New York, it's within 45 days of reporting to work. The New Jersey legislation would be 14 days. And they've either, shown contraction by testing or, documented evidence of symptoms consistent with COVID. For the New York legislation, they have a cutoff of the member having died before December 31st, and then COVID being a cause or contributing to the member's death. Similar in New Jersey, they have the main difference there is they've used a 14-day window. So looks like they've gone with that proposed legislation is using the concept of this 14-day window of kind of generally medically accepted evidence of the length of time between exposure and the infection taking hold. So if the committee is interested in sponsoring legislation related to the administration of death benefits for system members related to deaths caused or contributed by COVID, there are a few policy considerations that we flagged that you would want to consider. The first would be whether to establish a presumption that a member is who is required to report to work and dies as a result of COVID infection would be presumed to have contracted it in the performance of the member's employment. The next item would be whether or not you'd want to put a sunset on this, as New York has the cutoff at the end of this calendar year. Hopefully this is, a pandemic that is, of a defined, period, and looks like with, the oncoming vaccines that, we may be seeing some light at the end of the tunnel. So, providing a sunset would allow you to ensure that the benefit would be available, but would be available tailored to, the emergency situation. One other item that you would may want to consider is, clarity on how the presumption would apply regarding the employees reporting to work. As I mentioned, New York excludes employees who are working from home. And the proposed New Jersey legislation, the concept is when an employee is, going to the workplace or interacting with members of the public or other people outside their home as part of their job, that would satisfy the criteria. As far as the window of time, as I said, New Jersey's gone with that 14-day window. New York had a broader one, but if need be in the future, that can always be expanded if the medical literature and thought of or evidence of the exposure period changes. But 14 days seems to be what there's kind of consensus on at the time right now. You'd want to establish acceptable methods for verifying the death was caused or that COVID contributed to the death. So notations, for example, things like notations on a death certificate, submission of the medical records for treatment or statements by the treating medical professionals. And then the last item we've identified for you to consider is whether you'd want that any such legislation to apply retroactively, such as back to the beginning of the declared state of emergency in Maryland.
All right, thank you, Phil. We have a senator, if you'd like to speak before we go to questions, that'd be fine.
Sure. Thank you, Mr. Chair. I want to especially thank Philip for doing all the deep dive on this and carefully watching other states as they react to the pandemic. We wanted to provide you with a couple of options on the table and things for us to consider. And Mr. Chair, if you wouldn't mind, while we have everybody in the benefit of us being together, if anybody is, before we make a motion, any specific feedback on the policy areas that Philip outlined for us, we would like to be open to that. We've had internal discussions, but we want to make sure. Certainly,
Delegate Krim has her hand raised. Is that specific to this policy or one of the policies?
It is.
Okay.
It is. Thank you, Mr. Chairman. Yes. So I'm thinking back to what happened when they had the September 11th issue in New York, and people died years after because they had problems on the day of September 11th, ingesting some kind of chemicals or whatever. But they died very much later. So I'm wondering how this would work out in the event, because there's a lot of things we don't know about this virus yet. We don't know long-term effects. So are we going to say that you would have to have gone to the doctor and made some kind of effort to record the fact that you have the virus or you had it, you tested positive, so that if something comes up down the road years later, how are we going to react to that? I just want to know if that's covered somehow here. Okay, that's it. Thank you.
So I think with respect to this issue, there are a few things that provide some certainty, I guess, along the lines of your questioning. So the first is that this is applicable to when you have a member death. So with regard to that, you do have a defined event that is a certain event. It's you'll know when that occurred. And you should also be able to demonstrate through the employment records when the employee had been reporting to work, and then through the medical records when the symptoms arose or there was an affirmative diagnosis through testing or some other means. So the additional thing too is you do always have the ability to extend a sunset, and then one feature of having a sunset is while it does provide potential end date, it also does effectively require you all to come back and review how the policy is working. So you can get information from the retirement agency on how many people this has impacted. You'll be able to get more up-to-date medical information from the medical community on the effects of COVID. So at least right now, I think what we're seeing is we're not talking in terms of that year timeline. So as of right now, it doesn't seem like that's an issue. If that answers your question.
Delegate Krim.
Yes, go ahead.
If I may, thank you for that thought, because we've been tossing it back and forth internally, Delegate Jackson and I and the staff, about what kind of the long-term unknown health impacts of this disease, and so much is in flux right now. So it's very much our intention to make clear, maybe in uncodified language here, that we plan on returning and revisiting this issue next year, when hopefully we will know more about those long-term effects. Would that make you more comfortable with this?
Yes, because what I foresee here is that in the future, we could have those individuals who come forward with, and then we have to do some special legislation in order to accommodate. So that's what I'm trying to avoid here. But yes, if we come back next year and relook at this, that would be a good thing. Thank you.
You're welcome. Senator Becker.
Thank you very much. Am I unmuted? Yes. Thank you very much. And Philip, thank you for all your good work. Is there a way to craft the legislation that it is just as narrow and as tight as possible to be able to get it going? Does either one of those states have already done anything? Is theirs the most, covers as much as necessary so that you've considered all the aspects? Or combination?
Yeah, I think these features that these items that have been identified in the decision document, I think cover all the essential points. Yes. I think envisioning what this might look like as legislation, I think first let me say, I think this can be viewed, as I said before, while there's nothing in statute that would on its face prevent somebody from applying for and being granted benefit right now. This is kind of intended to clarify and provide some kind of uniformity in terms of how it actually gets administered. So it's some guidance to the agency rather than, maybe somebody is better at collecting their documents than somebody else, or maybe somebody has a better advocate for them when they're processing their application. So I think, yes, to your question, and again, as I said, since this is specific to deaths, there is that more certain element as opposed to the issues Delegate Krim was raising in terms of more the long haul effects, which.
Yeah, because we just comment, we have a lot of folks who work for the state of Maryland in vulnerable, what I would consider vulnerable places, who have very compromised health conditions. So how do we address that? Because COVID, seems to go after those folks that are compromised more so than others. Although that's kind of divided itself with some of our younger population. But I just want to make sure we've covered, all those folks.
Yeah, Senator, if I might, Philip, before you respond, Senator, in our discussions, that did come up. And as Philip mentioned, it's a defined claim if a death occurs, which folks would file for, they could file for the line of duty death. And I think the uncodified language and commitment to review after a year when we know a little bit more about what we're dealing with. We certainly believe that this is helping us, and I agree that we need to make it as tight as possible as we move forward to ensure that those who are in those vulnerable positions, whether they're working for public safety or healthcare or
Right.
others. So we do appreciate that.
Yeah, I think that touches all the points. I think the intent is to kind of provide this protection for the people that, have to go in and perform their job in person or interact with people to perform that job. Ideally, the state workforce would continue to utilize teleworking to the extent that it's available. And that should
But a lot of people can't.
Right. And so,
that's who it should be for those people who just are unable to do that. And even though you do the best that you can with infection control, things happen.
Right.
And
Yes.
Senator, thank you for bringing that point up. I think we're going to hear from advocates that even the state of teleworking has been in flux in the last 9 months and will continue to be. With folks being allowed to or having to come in. So keeping a careful eye on that is also important to us as well.
Right. So I think also the feature too, in terms of the window of time from when somebody, reported to work, for the people that may be doing kind of a hybrid of going in, teleworking, we will know that, they did report to a place that was, outside the home.
Right.
Senator Zucker.
Thank you very much, Mr. Chairman. I was just going to make a motion to move to adopt option A and have the joint committee sponsor this and try to clarify it as best we can.
Second.
Thank you, Senators. If there's any further discussion or is there anyone that's against option A? I don't see any hands. All right.
And Mr. Chair, just if I could just clarify in terms of
Yes.
a number of pieces. So I assume that motion would involve establishing the presumption, putting the 1 year sunset as discussed, clarifying that, the location of the members' work with the exclusion of working from home, putting a 14-day window from reporting to work to symptoms or diagnosis, creating the acceptable methods for verifying the cause of the death, either death certificate, medical records, statements by physicians, and then also applying retroactively back to the beginning of the state of emergency.
Thank you, Philip.
Thank you very much. So I think that concludes our decision-making portion. All right. So next we'll move to the annual state retirement and pension system investment overview. And before we do that, I'd like to offer an opportunity for the treasurer to address us if she likes. So, Madam Treasurer.
Thank you, Mr. Chairman. I'll be very brief on behalf of the Board of Trustees, which I have the honor of continuing to chair. I want to thank you all for having us. These are obviously challenging and sobering times, to wit the last discussion that you all had. And I do want to say that I'm so impressed by the folks who work at your retirement agency, most of them telework, but dealing right on time with all the calls and all the people, getting the checks out in full and on time. And even the investment division operating remotely, but making us a bunch of money and in the appropriate and monitored, risk managed way. So I just want to start off by thanking them as well as you for all the efforts you put on. This has been a difficult year, and as you know, we finished at about 3.57%, not where we wanted to be. We wanted to be at 7.40, but yet matching our planned benchmark and our peers, for which we are most appreciative. I told you I would come back, and I don't usually read, but I want to make sure I get the numbers right. That I told you I would come back with some specific numbers on how we compared to where we thought we would be in 2011 when you enacted the reforms. And basically the answer is we're on track. The retired employer contributions for this coming year, as you know, you actually saw them the day before the board voted on them, were 17.50% of payroll. It had been predicted to be slightly over 19%. So that's good for the employers. It's in part because, of course, the employers are not putting in 300 million a year, but that is, it's the way it is. As of June 30th, the funded ratio was 72.9%. It had anticipated to be just about exactly that, and a bit higher than last year. And thus, we are on track to be 80% funded by 2026, 85% by 2030, and 100% by 2039. But as you all know, we have to, as we approach the 2039 date, have to look again at how you constrain volatility and how you manage the risk as you have a shorter and shorter time. And I appreciate the fact that the committee will be working with the plan, approaching that time. And with that, those I think are the questions that were asked of us at the last meeting. And I welcome further questions. I usually say we're right across the street, but of course we're not right across the street, but we're a computer away, and turn it over to Andy Palmer.
Thank you. For the members who had questions in the previous meeting, were they answered, or are we going to revisit those later? Phil?
I think so. As I go through the investment overview, we do have a number of areas where we've asked the agency to comment, and so I think a lot of what was asked last time should be addressed in those responses.
Okay, thank you, Andy.
Should I go ahead with the
yes, sir.
Investment overview? Thank you. Okay, thank you, Mr. Chair. So we'll be turning to the fiscal 2020 investment overview. First off, I'd like to thank the State Retirement Agency for their assistance in preparing this document. In particular, CIO Andy Palmer, Deputy CIO Robert Bird, for providing a lot of the detail and feedback on the information that's gone into preparing this report for you all. If we go ahead and get started, I think support staff, we have some slides that put the exhibits into some slides, so it may be a little easier to follow along. But as the treasurer noted, the system for 2020 achieved a 3.57% return. Beginning with exhibit 1 on page 3, this just shows the system's asset allocation distribution. This has been in place since end of 2017. The asset allocation, will primarily drive the returns you see from the system. As you can see, with between the target and actual, the system has done pretty well at implementing the board's asset allocation strategy. The allocation is, reflective of a decision that in restructuring the portfolio back in fiscal 2008-2009 during the Great Recession, with an overall strategy of an approach to decrease risk through diversification. Increased investments in private equity have resulted in positive returns for the system with less experienced volatility than public equity. And lower allocations to public equity investments are expected to result in lower returns when those assets are in growth patterns. However, as those public equities can be highly volatile asset classes or assets, a more diverse investment allocation should reduce volatility to provide protection when equity markets perform poorly or decline. And while mitigating that volatility will result in sometimes not taking full advantage of highly performing public equity markets, more stable investment returns will mitigate swings in the employer contribution rates that need to be budgeted for in the state budget. Turning to, starting on page 4, with Exhibit 2 on page 5, we'll get into the investment performance. Performance was driven primarily by the growth equity returns, which make up about half of the portfolio, returned a little more than 2% for the fiscal year, which was about 2.5 percentage points above the benchmark. The system was able to weather the volatility introduced into markets with the spread of the COVID-19 pandemic and the interruption of economic activity resulting from public health measures. For the period ending March 31st, 2020, the system experienced significant losses of almost minus 6.5% in that 1 month period, bringing the fiscal year return down to about minus 3.5%, with total assets dipping down to 51.1 billion. The system did participate in the market rebounds, as you'll see reflected in the improved year-end performance. But in the month of April, there was a return of 4.47%, 0.77% in the month of May, 1.88% in June. The first comment DLS has requested from the agency is for the agency to comment on the plans for managing and responding to ongoing COVID-19 related market downturn and recovery impacts on system investments. Additionally, SRA should comment on how it plans to monitor and respond to any long-term structural economic changes resulting from the COVID-19 pandemic. Moving on to Exhibit 3, the system performed as a whole 0.43% or 43 basis points above the benchmark. As you see, the system had significant returns above the benchmark, again, in private equity, with a number of assets performing below their benchmarks. This brings us to our second request. DLS has asked the agency to comment on the fiscal 2020 return performance in relation to its policy benchmarks, and for any asset class and sub-asset classes that underperform the benchmarks, to comment on the factors that led to the underperformance, whether those factors are expected to negatively affect performance in fiscal 2021, and to comment on what actions are being taken to mitigate those factors from impacting the fiscal 2021 returns. Moving on to Exhibit 4 and our discussion of performance relative to other systems. So one method of evaluating the investment performance is to compare the system's performance to that of other states. The Wilshire Trust Universe Comparison Service, the TUX rankings, are useful for providing a big picture snapshot assessment of the system's performance. As you can see in this exhibit, the 2020 total fund performance was rated in the 53rd percentile among the public pension funds with at least 25 billion in assets. 1 being the highest, 100 being the lowest. So we've improved. We traditionally have been in that bottom quartile. As you see, the last few years we have seen improvement in there. Generally, the system's relative performance in these TUX rankings has been driven by a low allocation to equity investments compared to its peers. In particular, U.S. domestic equity. So as the system has a lower allocation to that, when those equity markets are experiencing strong performance, the relative TUX ranking will reflect that lower allocation. On their own, the TUX rankings can offer limited insight into the manner in which the system's asset allocation is driving the performance. The overall rankings don't fully reflect how Maryland's performance differs from that. of other funds in terms of how the assets are actually being managed. And when you go to Exhibit 5, we have here the TUX rankings for these periods by asset class. And as you see the experience of the system by asset class, you see significantly better TUX rankings relative to peers than you do for that whole system. You have a number of asset classes performing in that top quartile. You have fixed income coming in at number 1. And if you look at private equity on the 10-year, you have a number 1 ranking for that 10-year period. So as you see, between exhibits 4 and 5, the returns in the individual asset classes outperform the system as a whole. But all things being equal, a system with higher allocation to certain asset classes would affect that relative ranking for the system as a whole relative to peers. Systems allocation, back in Exhibit 1, you saw the board's determination of the allocation. There's a lot that goes into the consideration for setting those allocations. And some of those considerations, they largely play into the system's tolerance for risk. Systems maturity, which is the ratio of retirees to active members, should influence that, as well as the system's funded status, its assumed rate of return, the benefit structures being provided, the regularity of full contributions, which Maryland has been pretty disciplined on providing those. And some other considerations will factor into that. So the importance of those factors will vary from plan to plan, leading to different tolerances for risk, which will result in variations in investment allocations, leading to the differences in those relative return performances. I would note that over the 3-year period ending June 30, the system's level of risk was below the median for the other public plans as well. I would note there was also prudence in setting an asset allocation that should achieve the necessary investment returns with the lowest levels of risk capable of achieving those returns. So our next comment request is that we've asked the agency to comment on the relative TUX performance rankings by asset class and how the overall asset allocation impacts the total system rankings. And additionally, we've asked the agency to comment on how the system's asset allocation impacted the investment strategy for responding to COVID-related market downturns and rebounds. The next item is investment management fees, which is Exhibit 6. It's on page 10 of the document if you're following along there. As shown in Exhibit 6, the system incurred $364.1 million in investment management fees for fiscal 2020. This was down from $372.5 million in 2019. As a percent of assets under management, the fees were lower than fiscal 19 by 4 basis points. I also remind you that the total assets did increase since last year. I would note that review of the system's investment consultant has noted that the system has continued to be effective at negotiating fees more favorable than peer systems, and also that transitioning assets to internal management is also expected to result in significant fee savings to the system, as will be discussed further on. Regarding fees, one thing to note, the issue of active management. So there are a number of places in the portfolio where active management is employed as opposed to passive management. And the system has shown experience in achieving additional gains from that active management. If you look at Exhibit 7, we have a comparison of some of the assets where we have the ability to compare the active versus passive management. And as you'll see, and particularly with this 1 and 3 month period when you had the economic shutdowns and a lot of turmoil in the markets, and then the recovery, you'll see in that recovery period, the actively managed assets did perform better than the passively managed assets, indicating an ability to be flexible and capture some of those rebound advantages. So the system has demonstrated the ability to get its money's worth or achieve value from that active management, which does have the higher costs. Turning to two of the asset classes with some of the higher fee costs, the first being absolute returns. Fees paid for absolute return were $66.8 million in fiscal 2020, which represents about 18.3% of the management fees. Absolute return comprises 7.8% of the system's investments. It was among the lower performing asset classes in fiscal 2020 and did underperform its benchmark by 307 basis points. The system's policy manual describes the absolute return asset class as investments whose performance is expected to exceed the 3-month treasury bill by 4 to 5% over a full market cycle while exhibiting low correlation to public stocks. I would note that absolute return has performed below benchmark for the 1, 3, 5, and 10-year periods ending June 30, 2020. Since inception, the returns have exceeded benchmarks, but that return is 2.73% against the benchmark of 1.69. Prior responses from the agency have indicated that the absolute return asset class is expected to perform better in times of volatile, chaotic markets, and that absolute return should provide competitive returns with downside protections when a drawdown in equity occurs. So given the low rate of return, the underperformance relative to the benchmarks, and the high management fee structures, DLS has requested the agency to comment on the returns of the absolute return asset class, including the market conditions leading to the low level of returns and benchmark underperformance, and what market conditions would result in markedly improved returns for investments in the asset class. Turning to the next fee management, actually, if you can go back to Exhibit 6. Thanks. So private equity fees, similar private equity involves heavily active management. Fees for private equity comprise nearly 30% of total management fees, while the asset constitutes 14.2% of system assets. Again, the reason for these high fees is that they involve a substantial degree of active management, and the fee structures typically include a base management fee plus a portion of earnings referred to as carried interest. When the system pays higher carried interest fees, and these fees in the chart do not reflect the carried interest, but I would note that when the system is paying higher carried interest fees, you can expect to see a high return on that investment as those fees are based on the performance. So your return is going to be a multiple of whatever the fees you're paying for that carried interest. While private equity does involve substantial management fees, it has performed very well for the system. While the 2020 return was only 2.46%, the benchmark was negative 1.94%. So you had almost a 4.5% return above the benchmark. Returns for the 1, 3, and 5-year periods ending June 2020 were 2.46%, 11.69%, and 12.27%. And returns for those periods also provided significant returns over the asset class benchmarks. And as noted in the Tux exhibits, the private equity asset class has outperformed peer systems consistently with a ranking of number 1 for the 10-year period. One area I would note in private equity is that the system has begun utilizing co-investments in private equity. So these are investments when the system is doing a companion investment to private equity funds where the system is already invested in. And these co-investments don't carry the same associated fee structure. So under this approach, the system would effectively be reducing its fees for these private equity investments by doing these co-investments because the additional investment is not subject to those higher fee structures. One potential risk in utilizing this strategy, though, is that it can reduce and decrease diversification by consolidating the funds available for investing in private equity and fewer investments. Legislation passed in the 2019 session required the agency to provide more detailed information on the carried interest on the investments. And that first report was issued in January 2020, and it noted the carried interest of $162.5 million for fiscal 2019, which indicated an implied share of investment profit of $812.7 million for that same period. we have requested the agency to provide an update on estimated carried interest for fiscal 2020. The next item for discussion is the investment division staffing. And we can move to Exhibit 8, I think. Yes. So in 2018, legislation passed granting the board authority to set the compensation and personnel in the system's retirement agency's investment division, authorize them to establish positions and then establish the compensation. Since the passage of that legislation, the agency has been able to hire additional staff and move forward into internally managing assets. The board had approved 8 additional positions for fiscal 2020, having filled 5 of those to date. And an additional 6 positions were approved for fiscal 2021, 2 of which have been filled and 3 of which are expected to be filled by January 2021. One thing I would note is that legislation did provide authority to award incentive compensation based on the performance of the investment division staff that would be eligible. However, I would note, so fiscal 2020 was the first year that that would be implemented with 19 staff eligible for that incentive compensation. I would note that the legislation you all passed did include restrictions on the payment of those incentive compensation payments in years when state employees would be subject to a furlough. And so in light of this, given the uncertainty surrounding COVID, the board deferred the payment of those incentives until the fiscal year picture is a little clearer in terms of what that status would be, so that they would be in compliance with the intent of and the letter of the law. The second main purpose of the legislation back in 2018 was to allow the system to develop staff to begin employing internal management of assets. The agency has estimated significant savings opportunity through bringing asset management in-house, as you would be avoiding those external management fees. And since the passage of the legislation, there was $2.3 billion in U.S. Treasury inflation protected securities, $1.3 billion in long government bonds under internal management. And then so far in fiscal 2021, an additional $500 million in a Russell 1000 portfolio was funded. And the system is planning some additional investments internally in fiscal 2021, as noted on page 15 of the overview. The planned expansion into the internal management of assets is estimated to result in net savings of about $50 million by fiscal 2024, when accounting for the increases to the budgeted personnel and services expenses for the division. And you'll see this demonstrated in Exhibit 8 on the screen. The agency is estimating the division budget to increase from a little over $8 million in fiscal 2018 to $22.2 million by fiscal 2024, for a projected net increase of $14 million to the division budget. And we, DLS has asked the agency to provide an update on any investment division implementation of internal management of system assets and the development of necessary compliance and controls on the use of internal asset management. More specifically, the agency should comment on how the investment division has developed proficiency in managing assets currently being managed internally, how they will develop proficiency before expanding into management of additional asset classes, how they will evaluate the performance of internal management compared to available external management services, and how they will develop methodologies for determining fee savings achieved through internal management. The next item is the Terra Maria program. This is the system's emerging manager program. Discussion of this in the report begins on page 16 at the bottom of the document. So Exhibit 9 shows an overview of the program by manager and asset class. In fiscal 2020, the program did experience a negative return, 2.32%, and also underperforming the benchmark slightly. However, I would note, despite the poor overall performance in fiscal 2020, if you look at the fourth quarter of the fiscal year, you did see significantly improved returns, which you'll see on Exhibit 10. All four managers had significantly improved positive returns, all achieving double-digit returns for that 3-month period. Staff can move to Exhibit 10, please. Thanks. And then additionally, the program did outperform non-Terra Maria actively managed investments in U.S. equity and international developed equity, also achieving greater excess returns compared to the benchmarks. The final item on page 19 of the document is the system's currency program. This was adopted in fiscal 2009, and the program was designed to protect against losing value when the dollar appreciates relative to foreign currencies. So when the dollar appreciates, the program provides gains that help offset the currency losses generated by the strengthening dollar. And as of June 30, 2020, the currency program added total value of $283.2 million since inception. And Mr. Chair, Madam Chair, that is all I have for you today. I'll turn it over to the agency to comment.
Thank you, Philip. Do we have any questions of the analyst before we move on to the agency? Senator, I'm not seeing any hands. Oh,
thank you very much. When do we start the, is it the last program we talked about, the Telemera? It's off my screen. When do we start the entering program?
I think that was 2007, if I can jump.
Yeah, that sounds about right.
2008. We had an emerging manager program.
Emerging manager, yeah.
Yeah, yeah, and then we created this program, I believe, in 2008. That was before my time, but it's been in existence for a dozen years.
Okay, I was just trying to ascertain, the increase in the program, the value of the program, and the length of the program. Thank you very much.
And Senator, I believe a number of there have been managers who started in Terra Maria and have, I guess, moved into the larger system management structure.
all right. Any other questions? All right, on to the agency. Thank you.
Okay, this is Andy Palmer, the Chief Investment Officer. I want to thank you for having me here today. It's a pleasure. I got to come in the office. I have a tie on, which I haven't done in a long time. I get to talk to people that aren't my family, which is fantastic. So it's good to see everybody here. So thank you for the opportunity. And I want to thank Mr. Anthony for the very thorough and detailed report and the questions. He's asked some great questions for us. My intent was to sort of broadly talk about these topics in general and not get too focused in details. Bob Bird and I put together a pretty detailed responses for each of these written responses, which you have, which we can respond to questions. But I thought it'd be helpful to kind of talk more broadly about these questions than to get into the nitty gritty of each question. Broadly, there are questions about asset allocation, questions about performance, and question about moving toward internal management and the delegation of authority that the legislature has given to the board. So I wanted to focus on those things. So the first point is on the asset allocation, COVID, how that's impacted us and how our asset allocation is interplayed with the COVID pandemic. As was mentioned in the report, the system's asset allocation is meant to be built for periods of time of uncertainty. So we reduce the reliance on any one asset class to drive returns, and we try to build in asset classes that will perform better in certain environments to provide some protection. In the COVID example, the system has a allocation to long government bonds because we believe that they are good diversifiers and they provide protection against deflation. That asset class was up 25% in fiscal 2019, and the overall equity markets were low single digits returns. They were up 20% in just the second half of 2020, first half of 2020, second half of the fiscal year, when equity markets were down. So the portfolio design is meant to provide protection and see the agency through really rough periods of time and mitigate risk. Another aspect was the absolute return portfolio, which was mentioned in the report. That portfolio did very well in the March quarter and protected the system's assets. It underperformed mostly in the last quarter. It was all in the last quarter. It was ahead in that first quarter of the year for the fiscal year, and then the rapid recovery actually caught some of the managers on the wrong side. They were preparing to protect us some more, and they actually needed to be taking risk. So it's built to have these protective layers on it, and it has done that for us. Those protective layers kind of slow it down. I've used a race car analogy. You know, the more protective equipment you put in the car, weighs it down, it slows it down. So when markets are racing, you know, we're kind of at the back of the pack. But when there's a pile up, you know, we wind up skipping the pit and avoiding the crashing and move more toward the front of the line. So that's how it's designed. It's also designed with a mix of liquid and illiquid assets. So you know, those long-dated bonds are particularly liquid. We can sell those readily, and they are some of the most easily sold items that we have in the portfolio. Those went up sharply in the March timeframe, and so we were able to redeploy those assets, one back into public market stocks, which had become very much cheaper. I don't know if they were cheap, but they became much less expensive than they were. And we were also able to put money in different asset classes that also offered good investment opportunities. For example, we invested in some different credit products, mostly high yield type things, or different types of products like that became available because of the COVID pandemic. Overall, we didn't change the asset allocation, but we did take advantage of the changes in values to move assets around to be positioned for the recovery that we've been seeing. Longer term, the board has been working on enhancing its asset allocation setting process, and we have another meeting coming up in August where we'll review this, and we are preparing for that. And in that preparation, we will consider what has happened with the COVID pandemic to see if it impacts the long-term return prospects of different asset classes. So does this work from home process continue? And does that mean something for commercial real estate office buildings? So we'll have to think those things through and make a decision in August about whether or not we should be making changes to our asset allocation. And we have a number of topics we're considering for that meeting. One is, what do we do with bonds with a low interest rate? Now, we have very low interest rates. Bonds we still think maybe provide some protection, but they don't provide very much return. So that makes it harder to achieve our return target. We're looking at China. China is a big, depending on who you speak to, it's the source of this COVID-19 pandemic. And but it's also a very large financial market with different rules and but potentially very good return prospects. So we're thinking about that. We're thinking about climate change. We're working with our consultant to include climate change, not only in the discussion of individual assets, but in the discussion of asset classes in this asset allocation process. So lots of things we're building toward that discussion in August, and the pandemic factors will be included there. Turning to performance, we had a nice discussion of the things that went right in the period, and so we were thankful to be a little bit ahead, and that extra performance was what helped us move higher in the TUX rankings relative to our peers. And part of that was because the managers that we've had for a long time had good performance, and part of it was because the staff has taken actions to improve our ability to participate fully in strong markets. In the past, we do well when markets were poor, but we didn't really fully keep up when markets were stronger. And so we've taken actions to improve the traction we have to keep up when markets are strong. And you can see that playing out in some of the performance numbers that we can talk about. In terms of different asset classes, the ones you like to talk about are the ones that did well. The more challenging ones are the ones that underperformed. 70% of the asset classes did, and the assets did well. So that's a good year, and we expect that some will do well, some will do poorly. 20% of the assets, which would be the real estate assets and the credit assets, we think are performing reasonably within expectations. And really, it's a benchmarking issue for those asset classes that have some timing mismatch. We have public market benchmarks, and we have private assets that are priced with a lag, and even those prices are not fully exactly mark to market like a bond or stock would be. So we don't think there's any issue there. We've talked about the absolute return portfolio. This is sort of the poster child of the reason we came and asked for some help on resourcing a few years ago. The group that was in charge of this was understaffed and overburdened with the tasks that they had, and the performance was not very good. Both of those folks left. We hired a new person. She worked for a few years to slowly replace some of those managers, to build new ones. She left, become the chief investment officer of Hawaii. We moved somebody from our private equity portfolio, which had very good returns, as Philip mentioned, to sort of lead that effort. And now that's been in place for a couple of years, and we're starting to see the traction there. As I said, it was performing very well through the first quarter. Some unfortunate timing of investments. We hired some new managers just before the COVID this COVID process took over, and those managers were positioned in things that were particularly vulnerable to the COVID situation. They've recovered mostly so far this fiscal year, but in that next 6 months, it was 3 months. It was a real challenge for them. So we think that's on the path to improving returns. When we think about the low interest rate environment that we're in, the returns that we think we're going to be having from that absolute return portfolio are much more competitive, and we still believe it gives us a diversification process there. So focusing I'll just give you an update on performance for this fiscal year. For this fiscal year so far through September, the system was up about 6%, a little bit under 6%, and have been outperforming the benchmark by about 80 basis points through the end of September. I think in the Tux ranking, that put us like 9th percentile for the quarter, and in the top quartile, close to the top quartile, like 29th percentile for the trailing year. So that my point is keeping up again as markets are strong. The things we're doing are helping us keep up as when markets are strong. And then market took a pause in October leading into the election. A little bit of a back sell off, and then we've roared since the election. It's gone almost straight up. November was one of the strongest months on record for stocks. And so now for the end of we don't have final numbers in, so this is just an estimate. We have some managers still to report, but even with what we know, the system will be up over 12.5% for the fiscal year through the end of November, which is strong start, and close to 1% outperformance. So the benchmark will be about 11.5%. Is my estimate. It could be plus or minus around that, but so off to a good start this year. I'll pivot from performance to the team and the process. And I'll just remind you of the business plan that we're undergoing. As you remember, we're trying to improve the probability of meeting our investment objective with a three-pronged plan. One is we've been working with the board on asset allocation, as we discussed earlier, trying to improve the process of setting asset allocation. If we go back 5 years to like 2014 and look at the asset allocation we had in place then and compare that to the changes we've made and the performance we actually achieved, the asset allocation changes that we've made have improved the return on the system by over 80 basis points through fiscal year end per year. So 80 basis points per year. So the board has made great strides on fine tuning the asset allocation to continue to provide the risk protection, but also drive returns. One of the things that I would mention in that Tux report, it's not in the Tux report, we have a different service through September, our risk per unit of return per unit of risk ratio, we call the Sharpe ratio, but the return per unit of risk was first percentile relative to peers. So we're maintaining our performance relative to peers, and we're doing it in a risk controlled manner, which is really exactly what we're trying to do. So that was first thing's asset allocation. We think we're making progress there. The second piece has been to improve the implementation. And the big piece was to build out the staff to make sure we had enough people to do what we needed to do. And so that has happened with the first 9 hires or so after, with the authority given the board. And just as an example, all of the things I mentioned that the fixed income dean did in the March quarter, which was to move assets from stocks to bonds, hire 5 new managers in a period of about 6 weeks. We didn't have the bandwidth to do that without the additional staff members we put in there and the high quality staff members we put. So that's an example of improving the implementation by spending a bit of money to make that happen. The third piece is the internal management piece. And just to expand on that a little bit, we believe that the cost of our costs are, no, I should broaden it. The third piece is to lower the cost of managing the assets. There are 3 pieces to that. One is directly negotiating with managers to lower fees. As Philip mentioned, we're doing a good job there, and we've been having some success. The second is to manage some of the private assets directly. Those are the most expensive assets that we have. And we're working to develop partnerships with our managers to allow us to invest alongside them at lower or no fee at all type investments, which will help to average down the cost of investing in these private assets, which we've had particularly good experience with. And the third piece is to lower the cost by managing assets directly with staff. And so we've been working for a number of years to build this out. We've been building the ability to transact for a number of years because we did do some transactions internally. So we built that out to be more robust. And then in 2019, we added a large number of policies and procedures. We engaged with outside counsel to make sure we had as strong a policy process as possible. And then we use the same process for evaluating internal management opportunities as external. So whoever wants to manage a particular product, they work with us to develop it. They run a paper portfolio. They generate a set of guidelines, reporting package. They run through it for as many months as it takes to demonstrate proficiency. They take it to our internal investment committee to pitch, to get approval, to say we want to do this because we think we can do it better than the existing manager. And there's an iterative process there. And then we have a separate, once it's implemented, we have a separate group plus our consultant that provides oversight on the investment management. It's not just the team that's managing it. It's not just the asset class that houses the team. It's a separate group outside of that, sits above all the asset classes to evaluate the effectiveness of the management of those assets. So we're building a process to make sure that the internal products are as competitive as the external products. So as I mentioned, we've brought a few products in-house. We identified products that we believed would be susceptible to better implementation than we were getting from our existing manager. And so far that's been the case. We saved a small amount of fees, a few $100,000 in fees because we moved passive portfolios in, but those managers, we developed a process that we thought would be better. And the one we've had the longest that's began in July of 2019 with, it's got $2.5 billion in it today, that outperformed the external manager for the fiscal year by 20 basis points, which is about $5 million in fees. So an extra return. So we saved a few $100,000 in fees, but we made $5 million more in return. And the fees are important, but the ultimate thing is the performance. So we are focused on driving performance. Let's see. I had a couple of notes here just to check, make sure I'm on addressing all the topics. I will mention that this has all been done as the treasurer mentioned. The staff has been working on this on all these efforts from home, and we had a really robust disaster recovery plan, and we implemented that and sent everybody home. And remarkable, I think when you write the history of this, it's going to be noted how remarkable it was how the whole economy was able to transition. Most of the economy transitioned almost seamlessly to this new work from home environment. But the plan was for people to work with whatever they had at home or supplemented with some additional equipment from the system. That's proven to be a bit of a strain as we go into our 10th month of doing that. And I think that's the question across all businesses and governments, that we're still a bit strained in doing that. We have a plan to rectify that, but it's going to take some time because that part of our budget still goes through the regular procurement process. So we will address that eventually, but we think it probably will wind up with some work from home as a more normal situation going forward, and we want to make sure we have a robust plan for that. So just in closing, we believe that we'll have more strategies at the end of this year. Our ability to roll those out depends in part on our ability to connect and collaborate in this work from home environment and work with our partners. We've implemented some new systems, which has been a big lift. So we'll have more at the end of the year, and we should be on plan.
Thank you, Andy. Any questions from the members? Delegate Krim.
Thank you, Mr. Chairman. I apologize for my picture not being there, but I am here. My computer's not working for my picture, but I do have a question. A couple years ago, I believe we passed legislation on climate change and how that would influence our investments. So could you comment on how that legislation has impacted the investments here? And then I have another question. So thank you.
Sure. So the question is how the legislation on climate change is impacting sort of how we invest. And so if I just to summarize the legislation as we read it, it was a risk reporting bill that included climate change. And so we provide every year, and we're in the process of writing it up right now, a report on risk to the system, and in particular in climate change. So we've done that for the last 2 years. What the bill asks us to do and requires us to do is to survey literature, other plans, other actors on what their practices are on climate change, report on those, and consider whether or not we should be adopting any of those strategies for ourselves. As you know, we've been a member of UNPRI since 2006 under the Treasurer's leadership. These are topics that we have been embracing as an organization for that whole period. And our primary way of dealing with these risks is to make sure that we have risk management practices within our managers. So whenever we hire a manager, whenever we review what they do to manage these risks, whether it's climate change or anything else, and we basically kind of score them on whether or not we think the investment has a high degree of risk, and if or not, and whether or not we think their policies to address those risks are effective or not. And then we get them to report every year on how those things are changing. So we don't have any divestment, because we have believed that it's better to be at the table and invest in companies and try to make change that way to the extent possible. For example, we are a signer on Climate Action 100 Plus, which is a group that's trying to engage with large carbon emitters. And so we have those things, but we also have our fiduciary responsibility to focus on returns, and we are basing all of our investment decisions based on that metric. And so we're using climate change, ESG, and every other metric we can to make sure that we have an investment program that is addressing the risks that are inherent there. So it's hard because we have all these different managers doing different things to measure the effectiveness. One tool that we just recently started working on is we looked at a MSCI equity benchmark that evaluates, that was designed to focus on companies that were going to benefit from the transition from a carbon world to a non-carbon world. And that was built in 2013, created in 2013. And so you can see how that has performed over time relative to the broad equity benchmark, and it's outperformed. So what we did was we said, okay, let's look at that outperformance of that benchmark relative to the equity benchmark and see if it explains the outperformance of the system relative to its benchmark over time. And we found that it does explain about a third of our excess returns relative to the benchmark over that period of time. So it gives us some indication that the managers are embracing climate change in the way they implement the portfolio and the investments they're making. I mean, one of the reasons we have had such a good performance over the last year in our stock portfolio is one of our managers is the largest investor outside of Elon Musk in Tesla, which is a transition-focused company. And that manager outperformed through September of the last 12 months by 95%, not 95 basis points. The benchmark was 5. No, they outperformed by 90%. Benchmark was 5. They were 95%. They made a lot of money for us focusing on these things. So we think it's in our portfolio, but we haven't gone through and said, okay, we're going to excise all of these companies because we're not sure that's the most efficient way to do it.
All right, thank you.
Long answer. I'm sorry if I spoke so long. I'm so excited to have people to speak to. Sorry.
Yeah, we understand. Delegate Learman to follow up, and then we'll come back to Delegate Grimm.
Thanks. Thanks, Andy, for being here. And I think you probably know where I'm going, which is, and for those of you who haven't seen it, Bloomberg News reported today that the New York Pension Fund and Comptroller DiNapoli reported that New York has pledged to be net zero greenhouse gas emissions across all of its investments by 2040, which is a decade before any other fund that has made that sort of pledge, and that they're divesting from most oil and gas companies by 2025. And so I guess, I think you raised a lot of interesting points about how it can be difficult to assess how things are going, which leads me to wonder why we don't sort of just say, let's look at, other funds are doing this. This is the right thing to do for our money because of the risk of climate oil and gas companies and the risk that they pose. Are there any plans from the board or from you and the staff and investment managers to make a commitment to moving towards net zero investments?
I'll invite the treasurer to comment on this, and hopefully we're on the same page. So we've had these conversations with the board on a number of occasions, and we have nothing in our board documents that instructs me to do this. My documents instruct me to make the best investment returns that we can make and to address the risks there. And so that's what the staff and I are attempting to do. If the board it comes and says we think we should have this goal, we don't have a goal in our investment policy manual to say we should be net zero by X. We do believe that the world is a very dynamic place, and the best way to be an investor is to be flexible and not have hard and fast rules. So, for example, many of the energy companies themselves are saying we are on a path to net zero. British Petroleum has said they're going to be net zero, and so they're adopting this as well. So right now they're a carbon emitter, but you may be divesting from a company that's helping to create the change you're trying to achieve. So we're trying to be as flexible and address the issues with case-by-case analysis and relying on our managers to do that. We don't have the capacity in-house to do that. We're a different organization than the New York Common. That's a sole fiduciary, and they have some legislation, I think, that Comptroller DiNapoli is working on. But I think they're relatively an exception among public plans in terms of those goals. And I think that the goals on reducing their carbon is not new. I think they've been speaking about that for a year or two now. Hopefully we're gonna rhyme on that one.
Since Andy bounced it to me, I will say, Delegate, that the board is still putting its arms. The board recognized and put in its policies a recognition that that fossil fuels poses unusual and increasing, I believe that's fair to say, Andy recognizes, risk that has to be managed. And the first step was asking for a report on what we have and what others do. That's what Andy's working on, and establishing a system of due diligence so that when we look into managers, we ought to know how they deal with this risk and how they know what risk they have. And this would include, I assume, all of our private equity managers too. It seems to me that if the legislature is interested, we could then, either as the board or the corporate governance committee of the board, take a deeper dive, perhaps invite the participation of interested legislators and just lay out, not only in a written report, but in a discussion where questions can be raised, et cetera, where we are on it right now, what we have found, and what the options are going forward. I think the board would agree with Andy that our first number one option is not to walk away from the table and disinvest. It's to get people to understand risk, to grasp risk, and to do it not just for the immediate 12 months, what's my immediate bottom line, but what in fact is in the long-term interest. I would add also that before the legislature this year, I believe there's going to be legislation to increase the state's goals to a reduction of 40% by 2030, from 40% by 2030 to 50% by 2030, and still aiming for carbon neutrality by 2050 and perhaps 2045. Since that is the goal of the employer part of our system, and it seems to me that it's now appropriate, probably, Andy, to look at what we are doing within that context.
And that's helpful. Would that include some sort of, you mentioned private equity, so would that include some sort of discussion about how to get some of these private equity firms who like to wear green sleeves, but actually invest in lots of oil and gas to be more transparent? I mean, that's a lot.
I think if that is something, it's slightly more difficult in that area, right. I think, because they keep things closer to the vest, continue talking about their black hearts. Yeah. But as it becomes a greater and greater part of our portfolio, I think I personally think it would be very appropriate.
Right. Some minimum standards of transparency when we're putting our money with you. Yes. Yeah. I think, yeah. Okay. Well, yeah, I would definitely welcome that discussion, a further conversation on that. I think it'd be helpful for everybody.
Madam Chairman, Mr. Chairman, however you want to handle this, we can have a small group, we can have the the committee, that's up to you, of course.
Thank you. We will take that up.
Thank you.
Next, we'll go back to Delegate Krim's second question.
Thank you, Mr. Chairman. So this is along the same lines. Do we have anything on the books regarding human rights investments and doing an analysis? I mean, I bring this up because Mr. Palmer talked about China. So I don't know, so I'm asking the question. Thank you.
It's a great question, and it's a topic that we've been batting around in terms of China for the last 18 months or so. But it's something that's in all the investments we have, even the investments in the United States, we have to worry about human rights issues as well. The issue with China, I believe, just as a parenthetically, is in my mind, it doesn't appear that China is doing things that are particularly special to China. I would say countries like Russia do many of the same types of things. They do it with bullets and bombs, and China's doing it with belts and roads. But I think the difference is China is so huge, and we're also grappling with a sort of a rapid change in our perceptions of China and becoming more of a challenger to us than sort of a beneficiary of our largesse. I think we're kind of changing our viewpoint. So big picture on China is, I think part of the issue is that all of a sudden we're dealing with something we didn't think we had to deal with, and it's a challenge to figure out the process. But human rights, that's part of the S in ESG. So we really have to think about how we invest and what the risks are to us from investing in places that have poor records there. And so we have a lot of discussions internally about, how do we approach these things. We tend to think of about company by company because we're not necessarily investing in governments, but is one of the factors that we consider when we're investing in everything we do. But we don't have a separate report. I don't even know if we have proxy voting because human rights issues are not something that would be a proxy issue. They're more generated by governments than corporations.
I think there are some aspects of our proxy policies that in fact do touch on the substantive aspects, like child labor.
Exactly.
That sort of thing.
Yeah.
If the joint committee is interested, Mr. Chairman, Madam Chairman, we can certainly work with the corporate governance committee of the board to look through, to take on for this year, I think, the ESG agenda and look at where we are and report back to you on these range of things. It's a tricky, obviously, tricky areas. And we, of course, while not subject to ERISA, do follow ERISA to the extent possible. And we are fiduciaries of the fund. But on the other hand, again, we have to look long-term at what used to be called externalities, only a new year begins and they're right here. So we could certainly take that on if you all, I think it's appropriate and I hope you do.
Well, I think as much transparency as possible. That's always been something I live by. So if you could provide that to us and there's no objection, then I would ask the chairman to consider that. Thank you.
Yes, it makes sense. So any other comments or questions? Senator, do you see anyone?
I'm not seeing anybody. Thank you, Andy, for your thorough presentation. And Madam Treasurer, thank you. As always, you're on the cutting edge of these issues. So we greatly appreciate your proactivity.
Thank you.
So we'd like to first thank you, Treasurer, thank the agency and the board, the members of both chambers, my co-chair. I'll turn it over to you in a second, and obviously the staff. And I personally wish everyone a safe and healthy and a terrific holiday season. And that's for, you'll probably hear these as we finish out the year with our interim meetings, but just to be sure that I get it in as we move forward. So, Senator.
Thank you. I'll just add my thanks. This has been an interim unlike any other, and we appreciate how much commitment you've given to other joint committees, and particularly this joint committee. And thank you for the decisions we've made today. We will see probably all of you individually before the beginning of session, but we won't be together again until then. And just I echo the thanks of the agency and particularly our incredible DLS staff for guiding us through this. Thank you.
All right.
And just let us add our thanks to
Yes.
you, Madam Chairman, Mr. Chairman, and best wishes for a great holiday season.
Wonderful.
All right, everyone. I think we're done, right, Philip?
Yep, that's it.
Okay.
All right. Thank you, everyone.
Thank you all.
Thanks. Take care.